You've got to understand the financial markets. That's what's, ultimately influences things like consumer spending. If you get big wealth effects in the markets, it comes through on the high street. It's an environment where the Fed is pushing money in, where the People's Bank of China is pushing money in, and when bond volatility is low. So you've got a low sub 100 move index, say.
We can print money whenever we want. So I don't get it in the sense of how can we just print money whenever we want?
There's so much debt out there. There's $350 trillion of debt worldwide. And the fact about debt, the unpleasant fact, is it needs to be refinanced.
I'm your host, Jason Raznick, founder of Benzinga, a leading platform in the financial world with the mission to level the playing field for individual investors. And this is the Raz Report podcast, where we share inspiring stories, expert advice, and exclusive perspectives to keep you ahead of the ever-changing world of investments and entrepreneurship. Let's dive into the show.
Welcome to this week's edition of the Raz Report. We're super excited to have Michael Howell, CEO and founder of Cross Border Capital. Been in the financial markets for years, from Solomon days. I mean, you must have an interesting background. I read that book, on Solomon back in the day. Were you there during all that, during the heyday?
Jason, you're talking about Liar's Poker, and I was there on the trading floor in those days. Yep, absolutely.
Yep, Liar's Poker. I was going to say, but I'm like, hey, what if it's the other one? Yeah. So, is that book proper reflection of what it was like to be a trader on the floor?
Well, I think there was some truth in it, like a lot of things. It was a great read. Michael Lewis did a wonderful job, I think. It introduced a lot of people to Salomon Brothers and basically how the world of high finance worked in the late 80s, early 90s. Yeah, it was a good read. Still worth dipping into.
Yeah. Yeah, good friend, right? Was it
John? Good friend, yeah.
Were you good friends with him?
Well, I knew him. I met him a few times. Yeah, he was a good guy. No, sadly, no longer with us. But he was a big presence on Wall Street for sure.
Yeah, for sure. And then you helped develop the quantitative liquidity strategy there, and you became the head of Reach. And then you're at Barring Securities. So now you're at Cross Border Capital. It's like a fund management firm. What's your niche?
Well, the niche is basically what we do is we try and understand capital flows worldwide. We monitor what we call global liquidity, which is tracking the flow of money that's moving around the world. That was a major insight when we were at Salomon Brothers. It was essentially how markets operated. It was really watching where the money flow was. That was really what traders look at, and that's really the key to understanding market developments. A lot of water or a lot of liquidity has gone under the bridge since those years in the early 90s. But basically, the world is operating around an axis of global liquidity. That's what moves markets. That's what's moving Wall Street. That's what's moving Bitcoin. That's what moving all these asset prices. You got to understand where the global money is and where it's flowing.
So when you're tracking global liquidity, how are you tracking it? It's one thing to say that's how Bitcoin, all these markets. Are you looking? Hey, Spain is sending money to the U.S., converting. What are you actually looking at? Because I'm treat me like I'm an eighth grader here on this one.
Well, it's basically what we're doing is we monitor in a quantitative sense. So we're actually bean counting what each of these central banks and each of these financial systems create in terms of money. So we look at the actions of the Federal Reserve. We look at the actions of the European Central Bank. We look at what the People's Bank of China is doing. We also look at what private credit providers are up to. We look at things like repo markets, activity there. We look at what bank lending is doing, what's happening there. We look at shadow bank operations. So there's a whole range of different things. And then we also embroider on top of that what cross-border flows are doing. So we've got some sense as to whether money is staying in the US, whether it's shifting to foreign domains, whether it's coming into the US, etc. And tracking this is clearly a laborious exercise. It's a lot of detail. I mean, we're helped by the sort of virtues of technology and AI and whatever. But basically, what we do or what we come up with is an aggregate which is something like $175 trillion of money flow that wings its way around the world. And that is the mainstay of asset markets. That's what asset markets feed off. If that money flow increases, asset prices go up. If that money flow diminishes, asset prices crash. and they may need more central bank support, in other words, more liquidity to keep them going. And what we maintain through all this is it's not interest rates or interest rate expectations or Fed policy of moving Fed funds that's really a critical thing. It's the amount of liquidity in the system, which the federal authorities play a big role in. But it's not just about their interest rate tweaks. It's much more about the size and the composition of the Fed balance sheet, but equally the size and the composition of the People's Bank of China's balance sheet. All these things are important.
When COVID happened and the Fed was flooding the market with liquidity and quantitative easing, is that when you guys knew, okay, the markets are going to go up because the Fed is, giving so much money to the market? Or is that not?
Well, short answer is yes. But I mean, equally, when the Federal Reserve decides it's going to do QT and take liquidity out, then we go on the opposite tack and we say markets are likely coming down. But this is how markets operate. The financial system is very cyclical, and we've got to understand what are the forces pushing the cycle up, and what are the forces pushing the cycle down. And what you've had basically for the last 18 months since October 2022 is that liquidity has been forced back into the system, pretty much coincident with the Brits' gilt crisis in September of that year. So when the incoming government came into the UK and came out with an outrageous budget statement, and the British sovereign debt market sold off, we saw the beginnings of liquidity start to be pushed back into the system by monetary authorities worldwide. And that pretty much was the bottom. Then we got the US SVB crisis, Silicon Valley Bank crisis, in February, March of 23, and that was a further uplift for liquidity in the system. So these are the catalysts that are driving liquidity higher. And since then, you've got more, there's been basically more money creation within financial markets.
So you look at it's like what?
The cycle is going up, and the cycle is going to keep going up, probably well into 2025.
Because why?
Because central banks are easing, and you can see that not just in terms of their activities in markets, in other words, their quantitative actions, in other words, expanding their balance sheets, but you can see it now latterly in terms of the desire for rate cuts. You tend to find that central banks are like a super tanker. They tend to change direction meaningfully, but not frequently. So you see these sort of big moves that probably occur, maybe once every 3-4 years, and we're going through one now. The clear direction of policy now is towards lowering interest rates and trying to stimulate economies. By far and away, the best time for investors is when you've got slow economies, slow, sluggish economies that policymakers want to try and stimulate. And that's what we got.
Yeah, and so, but you, again, we're with Michael Howell, CEO of Cross Border Capital. He also has a Substack called Capital Wars and a book, Capital Wars, The Rise of Global Liquidity. So do you pay attention more to liquidity versus interest rate cuts or interest rate rises, whatever?
Far more. I mean, I'm not going to say interest rates are unimportant, but they're really a secondary feature in the world at the moment.
That's very interesting.
The simple reason for that is we're in a debt-dominated economy, and there's so much debt out there. There's $350 trillion of debt worldwide, and the fact about debt, the unpleasant fact, is it needs to be refinanced. So capital markets spend a lot of their time refinancing existing debt. If you've got $350 trillion of debt with an average life of 5 years, simple math says you've got to refinance $70 trillion every year. So you need balance sheet capacity to do that. And that's really what liquidity is about. It's creating that balance sheet capacity in the financial sector. And you think of a homespun example. Think of a home mortgage. And if you've got a 20-year home mortgage that's up for renewal, you're not so interested in what interest rate you're going to pay on a new mortgage. You're much more interested in when you're going to get the roll, whether someone is going to lend to you again. That's the critical factor. And so it is with debt. If you've got companies that are rolling over debt or trying to, what they really need is the roll. They'll pay any interest rate in the short term, provided they can get the roll. So it's not the interest rate that's really the governing factor. It's the capacity of the system to roll over debt. If you're in a new capital spending world where there's lots of new capital investment, then I'll come quietly and say, well, interest rates matter in that world because you're using interest rates as a cost of capital. But it's not the cost of capital that's critical today because we haven't got that much new capital spend. It's all about debt refinancing. Something like somewhere between $4 and $6 in every, probably in every 7 or 8 in financial markets are now basically debt refinancing flows rather than new capital flows. And that's the critical difference.
But what I don't understand is, like, we talk about the U.S. debt deficit and our total debt. We can print money whenever we want. So I don't get it in the sense of how can we just print money whenever we want? Doesn't that make it why does it matter, our total debt? I get we're paying interest on it, but it seems like we can print money whenever you want. It's an infinite, and that's where I get with the story of Bitcoin. But we can just print money whenever we want, the Fed, right? I mean, that's basically what happens.
Sure. Yep.
And so,
Well, there's
there's
quite a lot of that going on.
So what? So doesn't that deflate our dot? For example, I own T-bills, right? Isn't that stupid that I own T-bills then?
Well, you're currently getting about 5% carry on a T-bill,
right? Yeah, Got it. And so, when interest rates were rising and interest rates increased to what they are today, I had a thesis the stock market would fall because the markets, because you can buy T-bills or municipals or get savings rates at 5%. When interest rates rise, usually the stock market sells off. That didn't happen this time.
Correct. And part of the reason for that is that the volume of liquidity is increasing alongside rising interest rates, which may seem a paradox, but that's what's going on. The Federal Reserve may have high interest rates, but the fact of the matter is that it's expanding the amount of liquidity it's injecting into the system.
So I thought the Federal Reserve was not expanding the amount of liquidity, but you're saying they are right now. They still are.
They may be shrinking their balance sheet, but the reality is that the balance sheet is not liquidity. You've got to drill into the balance sheet and find out which elements on the balance sheet create liquidity or not. And the fact is they've been pushing liquidity into markets pretty much since October of 2022. And that's why the markets have been rising through that period. And what you're looking at is a classic bull market, a liquidity-driven bull market. What led it? Technology stocks. They're very, very sensitive to liquidity. Bitcoin, which is hypersensitive to liquidity. The price of gold, which is very sensitive to liquidity. All these factors are rising. It's a classic liquidity-driven market.
So we're, again, with Michael Howell. We had a couple technical issues, but we're back. I'm learning about global liquidity, and my thesis on interest rates may not be as important as liquidity. Before we go to your blog and your Substack, I know you're the author of Capital Wars, but are there certain metrics that we as an average investor can look at to judge liquidity? Is there certain quick things we should look at on a weekly or monthly basis, or that you would pay attention to, Michael Howell?
Yeah, I think there are a number of things. I think you can, if you want a pretty good barometer of whether liquidity conditions are strong or weak, I mean, I think you just got to look at the crypto market. I mean, just take a look at Bitcoin. That's pretty much telling you whether there's a lot of liquidity in the system or liquidity is scarce. It's a highly liquidity sensitive instrument. You can equally make that case for gold, although gold, may have other things going on. It's, clearly got geopolitical risk in there as well. But, hey, those two instruments together are not bad. I think you can look at the slope of the yield curve. That's not a bad indicator as well. There may be a few distortions going on with the yield curve now, given given the shenanigans that the Treasury and the Fed are getting up to. But generally speaking, the yield curve is not a bad guide. But I think if you want to step back and you want to look at some primary factors, the things that we look at a lot of numbers. But if I had to say what are the three most important numbers that we watch, I would say number one is monitoring Fed liquidity, which is something you can do, everybody can do every Thursday at 4:30 by looking at the Fed press release H4.1. That gives you a lot of detail about what the Fed's done in the previous week. You've got similar data which comes out of China. China's People's Bank is a very important central bank, given the fact that the Chinese economy has got an enormous footprint economically in the world, and China's People's Bank controls that, the tempo of the economy. So watch China. And then I think the third thing you've got to look at is a slightly wonkish indicator, but it's a key indicator, which is something called the MOVE Index, which is a US index of bond market volatility across the curve. And what that tells us is whether bonds are volatile or not. And that's very important for understanding what credit providers are going to be doing in terms of lending money out, because a lot of lending today is collateralized lending, and the collateral that's taken is government bonds. And if those government bonds are volatile, there's going to be less collateral available to lend out. So what you really want is an environment where the Fed is pushing money in, where the People's Bank of China is pushing money in, and when bond volatility is low. So you've got a low sub 100 MOVE Index, say. And those things are giving you a pretty good heads up to what's happening in global liquidity.
Okay, so you write about this stuff. How often do you write about this stuff?
Well, you write about it. We have a blog, which we probably produce a blog 3 times a week on what's happening in global markets. We try and understand quantitatively, what's going on. We give data to support that. And we also give commentary, narrative about what we think is happening in the world.
Got it. And the blog, if someone wants to read it, what is the URL? I think it's a Substack, Capital Wars.
Substack. It's called Capital Wars, available through Substack. That should be enough, I think, to get the coordinates.
We should syndicate some of it on Benzinga to give you another audience reach. I don't know if you'd want that, but we should, because this stuff is gold. I mean, in some because you're not giving individual stock plays, you're giving trends. Now, do you have your own financial advisory as well? Do you take on clients?
We do. We have an institutional service which is available. That we have a website which is crossbordercapital.com, where we provide all this data for quant firms or for traditional money managers who want some measure of risk control on their portfolios.
So if an institutional firm or financial, they have $10 million, you guys will take that and manage for them, or give them advice on what they should do?
We advise. We advise money. Got
it. And so, but most of your company, most of the people you work with are institutions, not retail.
Yeah, we do. I mean, the Substack is really a retail-based offering. The institutional service is obviously more granular. There's more detail. There's more data available. Yeah.
Got it. And I mean, you've been doing this for years. So the financial markets over the years, how have you seen, from your days at Salomon to where we're at today and to where you think we'll be in 10 years? What are some of the biggest changes from an institutional perspective and a retail investor perspective?
I think the biggest change that, I've seen, probably anyone's seen through the last 30, 40 years in terms of financial markets, is that if you go to any major town in any Western country, you will find on every high street a wealth manager. That wasn't the case 30, 40 years ago.
You'll find, you go to any major town, you'll find, what'd you say?
A wealth manager.
Yes. Okay.
Like an asset manager, an investment advisor.
Yep.
That's the big change. And that says there's a lot of savings to be managed. People want to manage their pension pots, their 401k plans, whatever it may be. So this is critical for people to understand. And it's no longer, institutions are no longer fulfilling that service. What you want is either dedicated wealth managers or basically individuals do it themselves through trying to understand market trends. And we're trying to fill that gap and providing information, necessary information to do that top-down macro style investing. So I think that's number one. I think number two is that, you've got over time, the world has become more international. International has become a big thing. I mean, I understand fully that the US markets have outperformed for the last 10 years, but that's not going to go on forever, let's face it. There's a bigger world out there, and you're going to start to see other trends developing. So we've got to be cognizant of how the world is operating. And even if it is the US markets that continue to perform, US markets are performing against the background of a global world. They're influencing US markets. So this is critical to understand as well. So I think those are the sort of takeaways, the main takeaways. We've always got to be conscious that in that international world, markets can be volatile. You've got to understand risk.
Okay. No, I mean, that is the trend. The trend that you talk about financial advisors in every major market. Do you think that's also because so many people, when online brokerage became a thing, went on their own and were doing things, and then they needed a little more, guidance, advice, because they didn't want to burn all their money and needed that? Or do you think like the growing trend of financial advisors in every market, do you think there's gonna be a lot more financial advisors in the next 10 years or less? This is what I really try to.
I think there's bound to be consolidation, but I think that generally there'll be more advice given. There's more assets to advise, put it that way, because the simple fact is that the financial economy is growing faster than the real economy, and that may be a function of demographics, it may be a function of wealth levels, but it's a reality. That's what we're facing, and because the financial economy is so important now, it's the financial markets that drive the real economy. Whereas if you go back 30, 40 years, it was very much the real economy that drove the financial markets. The dominance of the financial markets has really taken that, reversed that tendency. The world has kind of gone topsy-turvy in many ways. And that's how a lot of people see it. But, finance is really in the driving seat in many cases. You've got to understand the financial markets. That's what's, ultimately influences things like consumer spending. If you get big wealth effects in the markets, comes through on the high street.
Yeah, no, that's absolutely. All right. Now, these are some rapid fire questions we ask on the Raz Report. Again, with Michael Howell, Cross Border Capital, founder, CEO, was at Salomon back in the day, ran Desk, ran research. Read his blog on Substack, Capital Wars. We're going to get some blog entries on our site, Benzinga. You want to hear about macro, liquidity. I thought one of the most interesting takes was, when you're looking at liquidity in the market, look at Bitcoin. That's, I didn't even think of that way, because it's like, Bitcoin, I thought, was sentiment, but when there's a lot of liquidity in the market, I get it that you're it's a way to judge the if people are spending or investing and putting their dollars. So now here's some rapid fire. What advice would you give to your 20-year-old self, and what advice should be ignored?
I think the first thing to say is you've got to try and understand technology trends. That's really the key thing. And I think that if you're saying what was the world like 30, 40 years ago, it was basically one of understanding these long-term trends, the increasing financialization of the world, and the world was getting more international but equally more financial, and that was, I think, those are pretty good heads up. Watching how the money flows is a key takeaway.
Okay, another one. Who would you consider the most successful person of all time, and why?
The most successful person in investing or generally?
Either or.
I think the two heroes I would say would be in Britain, Winston Churchill, and in the US, Ulysses Grant.
Okay, why Ulysses?
Because he basically founded the Republic. He held the Republic together. He knew what it took to create a union, and he went for it. And that was it. He had a goal. He realized what the cost would be, but he did it. And I think the strength and foundation of US institutions today really arise out of those administrations. He proved himself to be a very loyal president to his, maybe unnecessarily to his cabinet. There was a lot of corruption in there, but he was a loyal man, true to himself.
Got it. No, that's a good one. What would you say a portfolio allocation should be for someone in their 40s? If they have, let's say they have a liquid, let's say they have a $2 million portfolio allocation. Do you still think it's like traditional 70% equity? Is what do you advise people on that kind of stuff?
Well, I think the traditional benchmark is 60-40. In other words, 60 equity, 40
Yeah,
bonds. I think that's no longer true. I think that you want to avoid bond duration, but that means holding long-term debt. I think you've got to basically have a cash allocation. So let's say that's about 10%. I think you've got to have a high equity allocation. Let's say that's 70%. And I think your other has got to be some mixture of, let's say, high yield bonds and things like Bitcoin gold. So I think I definitely have somewhere between 5 and 10% of my portfolio in things like precious metals or cryptocurrencies.
got it. So you're a big believer in this in the crypto that's not going to crypto's not going to stop.
I'm a big believer in monetary inflation hedges, and I think that monetary inflation hedges also include things like crypto, Bitcoin in particular. I'm not an expert on the intricacies of which particular crypto coin is going to be successful or not. That's not what I'm saying. I'm saying that if you look at the evidence, these counters are very, very sensitive to liquidity. And if you believe in rising global liquidity, which I do, you're going to see these things move up in price.
Interesting. And for equities, you're saying like 70% because you're saying over time, you're not talking 1 to 3 years. You're talking 15 years
I'm
from
saying
now.
yeah, you'll say a 40 year old who's basically going to be taking his retirement at age 65, let's say. So you've got 25 years of investment. I think what you've got to have is much higher equity content in a portfolio.
Got it. So you make a bet, a 40-year-old, so 25 years from now, that the stock market will be higher 25 years from now.
Correct. And you've got to lean towards technology.
Yeah. And like for example, my portfolio allocation is a lot. It's T-bills, municipals, and it's equities too. But the market's been up so much, it's a lower allocation. But because when you look at it on a daily basis, it can drive you crazy. But yeah, I hear you. So
Yeah, I'd say the other thing. I mean, without giving near-term recommendations or trying to look at tips. I mean, if you're getting over 2% from a 10-year tip, that's a steal. I mean, you find it really, really difficult to make more than 2% real in financial assets. So if the government is giving you 2% real in the tips market, that's not a bad return.
is there a limit of what you can buy for tips?
Not as far as I know. I'm not au fait with U.S. regulations. I wouldn't have
Okay,
thought
but
so.
no, I so you're saying that can gives you yeah, that's tips. Okay, inflation protected. That's interesting. Okay. Anything else that we have missed? I know. I'm sorry for some of the technical difficulties. Crossfire border. We got Capital Wars. Get his book, The Rise of Global Liquidity. Anything else that we should address, or anything you're feeling stressed in the markets? Um,
I think the key thing near term is to watch the dollar. I think that you've got a situation where the dollar is defying many people's expectations. I mean, we've been dollar bulls, but out there on the street, there's a lot of bears about the dollar. I think that's unjustified. I think the dollar is an underlying firm currency. Having said that, what you've got is the problem in terms of funding debt. So there's a lot of debt to finance, and the US have got to ultimately go to the money printer to finance the deficit. That will undermine the dollar, but the question is against what? I think it's going to undermine the dollar against gold. It's going to undermine the dollar against Bitcoin and crypto, but it may not undermine the dollar against the euro or the Japanese yen or whatever other major currencies, simply because the US is maybe the cleanest shirt in the laundry. In that regard, all other countries have got probably far worse problems, and they don't have the status of being a major reserve currency. So it's more difficult for them to fund their deficits. So I think the dollar has still got a firm underpinning, and I think through all this we've also got to recognise the role of China. Now I think there's a lot of misquoted or misplaced thought about China. The fact is that China is not the Soviet Union. It is not an autarkic economy. It is very highly integrated into the world, and that means it's very highly integrated into world financial markets. The ability of China to decouple from the dollar area is probably very, very minimal. They can do a certain amount, but they've still got to use dollar assets. And I think one of the factors is you see this paradox in world financial markets that the bigger the Chinese trade surplus, the stronger the dollar gets. And I think that's a paradox one needs to understand, but it's a reality. And if you get a slowing Chinese economy, which seems to be the case, the trade surplus seems to be blowing up, getting bigger and bigger. And that may be something behind a rising dollar. The Fed may not like that, but that could equally be a spur to the Federal Reserve cutting interest rates and adding liquidity through the second half of this year. So I'd be very closely watching the FOMC meeting middle of June to see if there's any hint of an upcoming rate cut ahead of the elections, and also expecting more liquidity to come in from the Fed.
Yeah, I mean, that would be a change. And then to hedge the inflation, or to hedge the dollar falling, you're saying buy gold, commodities, Bitcoin, crypto.
Correct.
Yeah, I don't have enough metals, that's for sure. Do not have the gold. I've seen it rise so much. I'm like, all right, I'm too late to the rally, but that's what I guess you think it's still going to keep going.
Well, look at a chart. Look at a trend line on a chart. I mean, that's a good way to see where it's going. I think it's going to go further. I mean, look at what foreign governments are doing. Look at for example, the BRIC countries and the BRIC friends. So include the Saudis and the Arab countries, OPEC and whatever. That BRIC club is buying gold like it's going out of fashion. They've now accumulated more gold than is in Fort Knox, and that's the reality. So gold is basically the asset of choice among central banks in this, in the opposition camp. Put it that way. So it makes sense to hold some.
Got it. Okay. All right. This is good. I appreciate you coming on. Sorry for our technical difficulties. It doesn't usually happen. So, but if you guys want to look up the blog, go to a Substack, Capital Wars. Michael Howell, he's been in the markets forever, and encyclopedia here. And Capital Wars is at Substack. We'll get some on Benzinga. If you want to learn about global markets, global liquidity, and how you can use it for your investing and making money, this is your guy. I would have made some more money in the market the last 2 years if I would have just studied liquidity versus interest rates rising, which that's what I kind of focused on. So thank you for the advice, and we hope to have you on the Raz Report in the near future.
Thank you, Jason. Much appreciated. Enjoyed it.
Thank you.